We're going to talk about Warren Buffett's investing rules. Hey, what's up, guys? You're watching Boss Your Money with Anthony. Please don't forget to subscribe to my channel down below, and also please don't forget to turn the like button blue for the YouTube algorithm. If you don't know who Warren Buffett is, Warren is one of the greatest investors of all time who is worth well over 80 billion US dollars at the time of making this video. That's billion with a B. So if you're ready to get started learning from the best, let's get straight into the video. So the first rule that Mr. Buffett always talks about is that cash is not a good investment. I've talked about this a little bit in my previous videos as well, and hoarding cash and saving money without getting any kind of returns is not at all a good practice. You have to remember that cash is always depreciating. It is always constantly losing value. Just by saving money and putting cash aside, it is not going to get you anywhere. If you manage to save $1 million, tomorrow that same $1 million is not going to be worth anything. So you have to always keep that in mind. So check out what Mr. Buffett has to say on cash.
Cash is always a bad investment. When people said cash is king a year ago, that's crazy. Cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough. It's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around. And cash, we will always have enough cash around. But anytime we have surplus cash around, I'm unhappy. I would much rather have good businesses than cash. And we found a chance in the last year or thereabouts to deploy. We came in with something over 40 billion in cash, right, and we've got about 20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
And it is a hedge against the dollar?
Well, you can say all assets are a hedge against the dollar. Right. All you know is that the dollar is going to be worth less 10, 20, 30 years from now. I say worth less, not worthless. Right. You want to watch that. But it will be, and that's true of almost every currency that I can think of. The question is how much it depreciates in value. But cash is not a place at that.
Another very important rule of Warren Buffett is always invest in productive assets. So what he's trying to say when he says productive assets is that don't buy something that doesn't actually generate money itself. Okay? So when you're investing in a business, the business has to be generating money for it to be a valuable investment. If you are investing in something that is purely based on demand and is actually not generating any value on its own, then that is not a productive asset. So I'll let Warren Buffett explain this in his own words.
So you could have a cube. If you owned all the gold in the world, you could have a cube that would be 67 or 68 feet on a side. And you could get a ladder and you could climb up on top of it and you could say, I'm sitting on top of the world and think you're king of the world. You could fondle it, you could polish it, you could do all these things with it, stare at it. But it isn't going to do anything. It's all you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything. But you're hoping that the person then thinks that somebody else will buy something 5 years later from him. In other words, you're betting on not just how scared people are now of paper money. You're betting on how much they think a year from now people will be scared 2 years from then on. The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time. And those are the assets that appeal to me and Charlie. Now, there's some logical follow-on to that. If you buy that farm and you really think about how many bushels of corn, how many bushels of soybeans will it produce, how much do I have to pay the tenant farmer, how much do I have to pay in taxes, and so on. You can make a rational calculation, and the success of that investment will be determined in your own mind by whether it meets your expectations as to what it delivers. Logically, you should not care whether you get a quote on that farm a day later, or a week later, or a month later, or a year later. We feel the same way about businesses. When we buy ISCAR, or we buy Lubrizol, or whatever, we don't run around getting a quote on it every week and say, is it up or down or anything like that. We look to the business. We feel the same way about securities. When we buy a marketable security, we don't care if the stock exchange closes for a few years. So when we look at Berkshire, we are looking at what we think can be delivered from the productive assets that we own.
The third rule of Warren Buffett is evaluate companies. Now, to understand evaluating companies, what he's trying to say is that it is very important for us to first assess and analyze the company. Forget about the share price, forget about the selling price. It's not about that at all. What it is about is that you have to analyze and assess the company on its own merit. Once you've done that, you need to find out for yourself what you are willing to pay for that company. After you've done all of that, you then go and find out what the selling price is. And if the sale price is less than your valuation, then you are good to go. And as before, I'll let Warren Buffett tell you in his words as well.
What we think about is how much is it selling for? How much do we think it's worth? When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
If you don't know how to evaluate a company, if you don't know how to read a financial statement, balance sheet, profit and loss account, cash flow statement, any of those things, all of those things, let me know in the comment section down below, and I will definitely make a video explaining each of those aspects. One of the other rules of Mr. Buffett's is to stay in your circle of competence. Staying in your circle of competence and doing what you know and what you're familiar with is very important. If you're doing something that you're not aware of, if you're doing something that someone else told you to do, you are out of your circle of competence, and therefore it is very, very, very close to gambling. So keep that in mind and stay within your circle.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it and the stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should.
Warren Buffett's fifth rule of investing is don't waste opportunities. He says that there are very few opportunities that are really, really good opportunities. So when you get those opportunities, it is important to seize them and take full advantage, and don't just tip your toes in the water. Go all out and get as much benefit from it as possible. Let's hear it from the big man himself.
Omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come. And because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
And last but not least, he always says, invest in yourself. We often forget how important it is for us to improve our skills and improve ourselves and spend money on ourselves, not by buying new things to impress others. I'm talking about actually sharpening yourself as a person and your skill set.
The best moat you can have is your own talent. I mean, they can't take it away from you. Inflation can't take it from you. Taxes can't take it from you. So when I talk to students, I see these students and I tell them, you're $1 million asset. I would pay you $100,000 to the MBAs for 10% of the earnings for the rest of your life. So that makes you $1 million asset. Now, if you can do something to increase that value 50%, if you can learn to communicate better verbally or in written form, and you become 50% more, that's $500,000 just by improving yourself. I mean, nobody can take that away from you. And so I urge everybody, when I talk to them in high school about this and college, is just develop the habits. You've got the brain power, you got the energy, but develop the habits of success and look around you at the people that you admire, and list what makes you admire them compared to somebody else that looks equally strong or equally talented. And those are things that you can do. I mean, just write them down and people like people that they like them if they're humorous, if they're friendly, if they give credit to the other fellow. I mean, and they don't like them if they're stingy, or they overstate and overpromise and all those sort of things. Well, that's a decision you make. So I encourage everybody to build your own moat around yourself.
I hope you've enjoyed the video, guys. If you have, please don't forget to turn the like button blue and subscribe to my channel. I'll see you guys in the next video. Take care.